This is Craig Hallgard with your Financial Issues Ag Update for February 17th. The biggest driver in the corn market right now is probably the South American situation. Ag Rural now estimates that Brazil's second crop corn is 11% planted, which is 20 points behind average, and the ideal planting window ends around February 20th. The later the corn is planted after that date, the greater the risk of reduced yields, and that has the trade nervous. Here in the U.S., weekly corn export inspections were very positive, coming in at 52.1 million bushels, which was at the top end of trade expectations. Good export inspections, coupled with South American concerns, had spot futures 13.5 cents higher at the close yesterday. For soybeans, the weekly export inspections number was disappointing at 29.7 million bushels, but the monthly NOPA crush report more than made up for it. The January crush report from the National Oilseed Processors Association was released yesterday, and it showed in the month of January we crushed 184.654 million bushels. Now that's the biggest crush month ever for the month of January. It's the second largest crush for any month, only behind October of 2020. In South American news, the harvest in Brazil continues to lag. 9% of the crop has now been harvested versus 24% harvested a year ago at this time. The good crush numbers and South American woes combined to push beans nicely higher in yesterday's session. Wheat traders were focused on hard red winter wheat country where we've seen bitter temperatures. It's estimated that up to 30% of the crop is at risk of winter kill, but the full extent of the damage won't be known until we come out of dormancy. Yesterday, however, the risk was enough to run the market as we had Chicago and Kansas City each over 20 cents higher, while Minneapolis was up roughly 15 cents for the session. Cotton futures posted another life of contract high. At the close, March futures were 85 points higher, settling at 88.12. Livestock futures turned in a split session. In cattle, traders are focused on weather, where record-breaking temperatures are front and center as they're impacting animal performance, feed yard operations, transportation, plant operations, labor and absenteeism, and so on. The weekly slaughter total last week was significantly smaller than expected at only 611,000 head, thanks to those weather woes. And that was down from 653,000 the prior week. This week is going to start off slow as well, and that will likely be supportive to cutout values this week. At the close, April live cattle futures were 62.5 cents higher, while March feeder cattle were down 7.5 cents. Hogs are impacted by the weather as well, as operations from the barn to the plant to distribution will all be affected. It looks as if the Eastern Corn Belt could get hit with another round later this week. That should lead to reduced production levels, which in turn should bring more strength to cutout values. Lean hog futures were stronger yesterday, with the April futures closing 97.5 cents higher for the day. Class 3 milk futures traded in a narrow range, though we did close near the high of the day. At the close, we had March futures 14 points higher as they settled at $16.70. Meat cutout values were mixed. Choice box beef was $2.33 higher, closing at $234.77. Select boxes were 62 cents higher as they settled at $222.03. Pork carcass cutout values retreated, finishing $1.55 lower, ending the day at $89.71 per hundredweight. This has been Craig Hallgard with your Financial Issues Ag Update. We'll be right back with more financial issues after this.